The same institution, same logo, same building, same sign above the door, treats you like a problem to be managed or a prize to be won, and the only thing that decides which one you are is the number sitting in your account right now. Your account is in the red. Maybe it's $8, maybe it's $350. The exact figure is almost beside the point because the bank's response doesn't calibrate to how far under you've gone. It triggers. Full stop. Within hours, an overdraft charge lands. $35 at most major institutions. Some charge that fee per individual transaction. If 4 small purchases clear while your balance is negative, you don't owe 1 fee, you owe 4. That's $140 in penalties on top of a deficit that was already keeping you up at night. And here's what makes this almost cruel in its precision. The fee is largest for the people least equipped to absorb it. If money were sitting in your account, you wouldn't be overdrawn. Because there isn't any, the bank subtracts more of what you don't have. The logic is circular, and it compounds downward. Picture the moment. You're at a pump. The card reader blinks. Declined. You tap again. Declined again. There are people behind you. You are running mental math. Did last night's transfer go through? Was it enough? What day does the paycheck post? And none of the answers are arriving fast enough because the terminal is still blinking and the line is still watching. The anxiety of that arithmetic is real, and it is not something the bank is designed to register. That is what financial pressure actually looks like, not a dramatic scene. A blinking terminal and a calculation you cannot finish in time. The bank has a product for this situation. Overdraft protection. What it actually means. Rather than declining the purchase and preserving your dignity at the register, the bank covers it and charges you $35 for doing so. You paid for the privilege of not being turned away. Some institutions have reduced these charges under regulatory pressure. Most operate as they always have. The accounts absorbing these fees most frequently belong to the people who can least afford to pay them. Banks pulled in more than $7 billion in overdraft revenue in a single recent year, and most of it came from a narrow slice of accounts chronically in the red. The same households paying repeatedly for the cost of having nothing left over. The system holds one fact about you, your balance, and builds your entire experience from that single data point alone. Credit cards? Not available here. Personal loans? Not an option. A human being who will listen to context or offer any flexibility whatsoever, what you receive is automated. A charge processed by a system with no knowledge of why the account went negative, that your direct deposit posted 2 days late, that the charge was a subscription you meant to cancel, that this is an isolated event. The system holds one fact about you. Your balance is below zero. Everything downstream flows from that. You are not a client at this level. You are a liability the institution is trying to recoup. You've brought the account back above zero. There's $200 in there now, sometimes $400, occasionally $600 before rent pulls it down again. You are technically in good standing. That distinction matters less than you'd hope. Here is what good standing actually earns you at this tier. A monthly maintenance fee. $12 or $15 withdrawn automatically because your average daily balance didn't reach the threshold required to waive it. That threshold is often $1,500, sometimes $500. If you had $1,500 sitting still and untouched, the charge would disappear. Because you don't, it stays. You are paying a monthly fee to store money you don't have enough of to stop being charged for storing it. The account itself costs you money simply by existing. The account type is standard, basic checking or basic savings. No elevated interest rate on the savings side because your balance doesn't qualify for the tiered structure. Your money earns around 0.01% annually, while the bank deploys those same deposits as loans at 7 to 24% depending on the product. The margin between those two numbers is the engine of banking. At your balance level, you aren't producing enough of it for the institution to compete for your loyalty. You apply for a credit card. The offer you receive, if you receive one, is likely a secured card. This means you put down a deposit, say $300, which the bank holds as collateral while lending you up to that same amount and charging interest on whatever portion you use. You are funding your own credit limit. This arrangement is lawful. It is the standard entry point for building credit history from the lower end of the financial spectrum. The service is not unkind. It is impersonal. The teller greets you normally. The app functions. When you call about a problem, you wait on hold, then reach someone working from a script who resolves routine issues and escalates complex ones to someone you'll never speak to directly. There is no relationship being cultivated. There is a transaction being processed. You are a number in this system, a small one, and small numbers get managed, not nurtured. Something shifts. It doesn't arrive with fanfare. Income stabilizes. Direct deposit lands every 2 weeks, reliably, around $3,200 a month. The bank doesn't call. It doesn't send a congratulatory message. What it does is update its internal model of your account behavior, from irregular and underfunded to consistent and moderate. Credit card offers begin showing up. Not secured cards this time. Standard unsecured cards with limits of $2,000 or $3,500. Interest rates are still high, 22 to 26%, because your credit history is still building. But the access exists now. The institution that had nothing to extend you 6 months ago is surfacing offers inside the app. Your predictable income has reclassified you from unviable to worth pursuing. The bank didn't warm up to you. It updated its risk model, and your new income pattern changed the calculation entirely. You apply for a small personal loan, $5,000 for a necessary repair. Approval comes within 48 hours. The rate is 11%, which isn't a bargain, but it works. What you notice isn't the terms. It's that the process functioned. You needed capital, you requested it, and it was extended. For the first time, the institution behaved the way people describe banks behaving in stories about what banks are supposed to do. The maintenance fee has likely disappeared because a qualifying direct deposit triggers a waiver. This feels more significant than the dollar amount suggests. You paid that fee long enough that its absence now registers as something worth acknowledging. You are finally a customer, recognized, serviceable, and worth keeping for as long as the revenue continues flowing your way. The bank wants to retain you because your account produces value. Card interchange fees, loan interest, deposit balances lent out at a margin. You matter instrumentally, conditionally, and with a quiet understanding that your exit would be handled without ceremony. Nothing dramatic happened. You were simply consistent. The savings account has grown to $18,000. The investment account holds another $22,000. The credit card balance is zero every month, making the 24% rate on the agreement functionally meaningless. You never trigger it. Over several ordinary years of ordinary decisions, your financial profile began looking like something banks actually compete to serve. Your credit ceiling expands without you requesting it. You log in and the limit has moved from $4,000 to $9,500, then to $14,000. The bank is extending headroom to a borrower whose record shows they don't actually need it. You pay on schedule and don't run balances up. This profile is what risk models classify as low cost and high quality, and the institution responds by offering more of what you've already demonstrated you can handle responsibly. When you finance a car, the rate offered is 6.8%, down from 11% a few years earlier, not because the banker has developed personal affection for you, because your credit score and asset base move the risk calculation. Lower risk gets priced with lower rates. The price of borrowed money has dropped because the evidence now shows that lending to you is safe. This is where compound advantage becomes visible. Better rates mean you pay less for the same purchase. Paying less means more capital stays in your hands. Capital that stays accumulates faster than capital that gets extracted. The bank's calculations are tilting your direction, not dramatically, but measurably, in basis points, approval speeds, and the quality of products being offered. If you walked in today and mentioned shopping around, someone would make a retention offer. That is new leverage, something that simply did not exist 3 levels ago. Your combined asset picture now sits above $150,000, savings, investments, and a retirement account compounding faster than originally projected. You are not in the top tier of wealth, but you are in the top segment of what most retail bankers encounter in a given workday. The experience begins reflecting that. The phone line is different. Priority routing places you ahead of the general queue. The person who answers holds more authority. They can waive fees on the spot, approve exceptions, and make decisions that would require multiple escalations for a level 2 account. When something breaks, and eventually something always does, the resolution arrives in the same conversation rather than at the end of a callback chain. That is not a small difference. A named contact may appear. Someone assigned to your account who emails you directly, checks in periodically, and actually knows what's in your file. The relationship has a commercial foundation. That banker's performance metrics include retention of accounts at your level, which means their attentiveness is professionally incentivized. Knowing this doesn't make the access less functional. The attention is real and useful, regardless of the motivation behind it. Pre-approvals begin arriving. For mortgage qualification, for premium credit products carrying real rewards instead of 1% cashback, for investment offerings not previously available to you. The institution is now calculating not just what your account is worth today, but what it might become. You are a preferred client. Your name is flagged. Someone has been assigned to make sure you don't leave. Somewhere between $500,000 and $1 million in investable assets, something fundamental changes in how the bank positions itself relative to you. It stops being a place you go and becomes a service that arrives. Wealth management becomes available. A bundled offering wrapping investment guidance, financial planning, tax coordination, and estate structuring into a single ongoing relationship. The quality varies considerably. Some advisors are genuinely skilled. Others are expensive salespeople with impressive offices. You figure out which type quickly because the difference shows up in your returns. The texture of conversations changes. You are no longer being sold a product. You are being asked about your goals, your timeline, and what you are building toward. The bank is mapping your complete financial life, not out of personal interest, but because a fuller picture allows them to capture more of it. The motivation is commercial. The output is personalized service. Both are simultaneously true. Loan approvals compress. Documentation gets lighter. When a wire transfer goes sideways or a fraud alert locks an account you need immediately, the problem resolves inside a single call. No callbacks, no scripted responses, no escalation chains. Someone with real authority handles it in real time because your balance warrants that response. You are no longer a customer. You are an asset the bank is managing and protecting. The protocols governing your account are fundamentally different from those applied to a Level 2 holder, even if both of you are standing in the same branch looking at the same logo on the same wall. Above $5 million in assets, the bank begins showing you a menu that is not publicly posted anywhere. Products that don't appear on any web page. Rates never printed on a branch board. Access to investment vehicles requiring accredited investor status. Minimum commitment thresholds, or a depth of relationship history that disqualifies most people from consideration. These offerings exist inside a tier structured around the assumption that most people will never reach it. Your mortgage rate is materially lower than what a borrower at Level 3 would be quoted, not marginally, but meaningfully, by enough to represent tens of thousands of dollars across the life of the loan. The bank competes aggressively for that mortgage because your profile represents minimal risk and brings ancillary business across its entire product suite. Your advisory team is specialized. One person handles investment strategy, another manages tax architecture, a third oversees estate and trust structuring. They coordinate internally, update each other, and meet with you quarterly in a room architecturally different from the standard waiting area. Better chairs, better lighting, and a conversation with genuinely different stakes. The regulatory rules governing retail banking still apply to everyone, but the bank's internal policies carry discretion built in, and that discretion is exercised consistently in favor of accounts generating the most significant revenue. Waiting periods shorten. Fee schedules become suggestions. Approval timelines collapse. The framework exists for everyone. How it gets applied is another matter entirely. Private banking is not a premium version of regular banking. The distinction is not one of degree. It is categorical. The way a chartered aircraft is not a better seat in economy, but a different mode of transportation organized around entirely different assumptions. At this level, you don't have a banker assigned to your account. You have a private banker, a role with specific internal meaning. This individual manages a small portfolio of relationships, sometimes fewer than 20. Their professional life is organized entirely around those connections. They know your family structure. They understand what you're protecting, what you're building, and what you plan to pass down. They have direct access to senior decision makers who can architect arrangements that exist nowhere in the standard product catalog. Every term is negotiated rather than published. Loan rates are arrived at through conversation, not listed in a brochure. The minimum investment required for a private equity co-investment gets adjusted because the relationship warrants it. Documentation consuming 2 weeks of processing time for a retail client is handled internally within 48 hours because the people moving paperwork have been told who this is and why it matters. The rules still exist at this level. The bank simply holds the latitude to interpret them, and that interpretation runs in one direction. Banks do not circumvent laws for wealthy clients. What they do is find every inch of legal flexibility within their own policies and exercise it in favor of relationships generating the most significant revenue. Fees that technically apply get waived before anyone asks. Exceptions requiring approval get approved before the formal review begins. The automated system that processed your account at Level 1, the one that didn't know your name, didn't understand your situation, and didn't care, That same institution is now human, deliberate, and structurally oriented toward accommodating you. You are not a client here. You are a relationship, a named entry in someone's performance review, a figure in their retention metrics, a person whose departure would be felt by people whose careers are partly defined by preventing it. That is a form of power that cannot be purchased directly. It is extended, gradually and conditionally, by the same system that once charged you $35 for dipping into the negative. The distance between those two experiences is not a matter of better customer service. It is a different world, operating quietly inside the same institution, waiting for a number in your account to change. If this breakdown clarified something you hadn't considered before, hit like and follow Money in Levels. We map how systems actually work at every tier, every time.